This is Rippin It, a video podcast with Derek Ripp. How you doing this morning, Derek?
Doing great. How about yourself, Kevin?
I'm doing well, but I've got to be honest with you. I've been wrestling with a concern about inflation. I want to talk to you about it.
Yeah, that's
I
definitely timely.
say that again.
Definitely a timely topic.
I think so, and I try to be cautious about this because there's no shortage of what we call perma bears, who are the folks that have nothing but gloom and doom to talk about with the economy and inflation and money printing. So I want to be cautious not to fall into that camp, but I have to tell you I'm a little concerned.
Yeah, we don't want to drive all of our viewers here into those underground bunkers.
That's not the intention. But I characterize inflation as a dog that's not barking and has not barked for a long time. We haven't had inflation that's been meaningful since the 1970s. That's the Nixon days when we came off the gold standard. I was not around then. I think if you were quite a young man.
Yeah, I can't say that I personally remember it, but I've heard stories about the lines at the gas station and high inflation.
Inflation hit 15, almost 20% at some point in the 70s, and a mortgage cost about 15% at some point coming into 1980. Those are very different times, but interestingly, similar circumstances in that when we look back and try to figure out why that happened, some part of it was probably due to money printing. This was when the Fed just started amping up its operations because we came off of the gold standard. And Nixon, in an effort to try to avoid a recession, added a lot of money to the economy. So looking back on it, that is what sparked some of the inflation, we think. And here we are, fast forward to the year 2020. The national debt is $24 trillion. That's a T, trillion with a T. Back in 1990, the debt was 3 trillion. In 2000, it was 6. In 2010, it was 12. It's now 24 trillion. That expansion is rather recent. We're talking about a period of 30 years and a massive expansion. That's something different. And I'll just say one more thing on this. The theory as to why this will work, I think, is called modern monetary theory. And what that means is the government should go ahead and spend freely, because as long as there's demand for the dollar and as long as we have enough productive capacity in our economy, it won't lead to inflation. And I suppose that's been true until this very moment, as inflation now approaches zero.
Well, yeah, and one of the key points you mentioned, I think, is the demand for the dollar too. So will that demand continue? And maybe there's some signs that the world is moving away from the dollar, and that could cause potentially some inflation.
Yeah, and my concern, I guess, comes down to we're trying something that hasn't really been tried before.
Right.
And there's no way we can be sure of the outcome, but we are experimenting on a scale that I cannot even fathom what $24 trillion. I don't know how many football stadiums full of $100 bills you need to represent $24 trillion. Do you?
It would be a lot. A lot of times they have the statistics of the trips to the moon and back. So it's probably several stacking dollar bills, several trips back to the moon and back. So it's a big number, and most people, I think, would have a hard time wrapping their mind around how much money that actually is.
Yeah, me included. So the question is, will this ever catch up to us and be a problem? And if so, what would be the conditions in which that would happen? And the definition of inflation is more dollars chasing after the same or fewer goods and services. So you have people with more dollars, they need stuff, and they have more money and less stuff to buy, and that drives up prices. That's the basic concept. So here's a reason why I'm even more concerned. Back in 2008, the Fed assisted in something like a $3 trillion stimulus during the global financial crisis back in 2008. Well, that $3 trillion, most of that ended up staying in the banks on their balance sheet. So it didn't make it out into the general public where people were spending it. It stayed in the financial system, but it prevented the collapse of those banks and other institutions. This time around is different. I was looking this up because I was so curious about it. Where did all the money go this time? Because it's another $3-4 trillion of stimulus to deal with the pandemic situation. Well, this time it went into the checking and savings accounts of many Americans. Not all of it, but a whole heck of a lot of it. There's a measurement called M2 that is basically available cash for spending in the economy, to keep it simple. In 2018, that number was 14 trillion. In 2019, it was 14.5 trillion. And right now it's 18 trillion. That's a huge jump. And that is money that, through whether it's the direct stimulus checks or the payroll protection program for small businesses, that's money ending up in bank accounts for people to spend. Right now, as you sit in Wimberley in your house, and I'm here in Austin with really no plans of going out today, there aren't a lot of places to spend money. It's been harder to spend money right now, but we have more dollars. So this seems to be a precarious circumstance.
Yeah, and that is definitely an interesting point. And it can take some time before inflation really kicks in. But I was just looking at some numbers recently about inflation, and where, using the consumer price index in January, when we started the year, it was about 2.5%. And once this pandemic hit, in March, that dropped to 1.5%. And then, it dropped again in April and May. So as of the end of May, it was only 0.1%. So, to your point, we really haven't, a lot of people have been staying home. They haven't been spending as much money. Maybe they're spending a little bit more on food, but less in energy. And there's still, the offset between those. It is basically, we don't have inflation right now. But I think if you look back to the Great Depression, which was probably another period of time where there was massive money printing, the inflation wasn't immediate. It took some time before it set in, maybe closer to a decade later before they really started seeing effects of all that money printing. So some of this might be, we have to wait and see.
Certainly. Who knows when and why it happens, but the effect could be catastrophic, particularly for retired folks. And I think it's hard to put inflation in perspective. But in the 70s, I mentioned inflation was high. Basically, something that cost $10 in 1970 cost $21 in 1980. That's a doubling in 10 years. Mm-hmm. So what that means is if you're retired today and you're living off $100,000 a year before tax, in 10 years, you'll need $200,000 to live the exact same lifestyle. That's not nothing. And the other way to look at it is, if you're expecting a return on investment of 8% per year and inflation is 5% per year, you're really only gaining 3% in terms of what you can buy with your money. That is awfully concerning for somebody who's on a fixed income, where Social Security is a good portion of their income, maybe a pension. How do you think about what retired folks can do to prepare for the possibility that there could be higher inflation? I'm not talking about runaway superinflation, but inflation that's not 1 or 2%, but 5 or 6%.
Yeah, that's an important point that you're bringing up, which is, monitoring inflation and what that rate is. I know from a financial planning perspective, we use more the 50-year moving or the 50-year average, which is closer to 3.7. So if that number increases, then we need to, adjust the plans accordingly so that we can forecast that out. So definitely a wild card in the planning scenario. But as far as asset allocation is an important piece of that, because if you look at the three major asset classes, cash, bonds, and stocks, we know that cash net of inflation is a loser. You're gonna lose money in cash. A lot of people don't think about cash from that perspective, but even at current inflation rates, you're going to lose money net of inflation in cash. And bonds are will most likely break even or maybe add 1 to 2% net of inflation, above inflation. And so, bonds are not going to be a huge provider of return as well. And so what happens is it forces investors to take more risk in stocks, in equities. And that may not necessarily be the best thing, especially if clients cannot handle the volatility that comes along with owning stocks. So really helping clients to prepare for and maybe develop different segments of income in more of a retirement income planning approach, so that we have sufficient equities to outpace inflation, but we also have different segments of income to draw from in the short term. So call it in the less than 2 years, we have a segment of income that is really no risk, and maybe years 3 through 5 or 3 through 8. We're taking some risk, but structuring the portfolios to where clients can avoid having to get to the equities for at least 5, if not 10 years is ideal.
Agreed. Inflation is bad for cash. It's bad for bonds, most bonds. Stocks do a bit better historically, and the interesting reason for that, I think, is that companies can raise their prices and pass them along to consumers. So if a company makes something that people really need, they're more likely to be able to raise their prices, which will then pass through to the shareholders of the stock in the form of higher stock prices. And that can help when there's high inflation. I don't know how much that helps when there's runaway inflation, but it helps when there's modestly above average inflation. What do you think about another category of investments which have been overlooked, discarded? I don't hear many people talking about investing in commodities in any significant way. Commodities have had horrible returns over the last decade as inflation has been very low. What do you think about some sort of an allocation to commodities, which are literally the price of things? So if the price of things is going up, that will be reflected in commodities.
Yeah, I think that commodities are a good hedge against inflation, and deserving of a piece in an asset allocation. The challenge that you brought up is that a lot of investors are very short-sighted and short-term thinking, and because commodities have done so poorly relative to, say, just a broad benchmark like the S&P 500, that they become overlooked, right? So and that's part of owning a diversified portfolio. Is typically you're going to have asset classes that behave differently from one another, and that's intentional, so that sometimes you're going to own things that don't do as well as, say, the overall stock market. But commodities are deserving of a piece of the asset allocation, and whether that's commodities like gold or food or oil, they all tend to do well in more inflationary type environments. And also the countries that tend to produce those, a lot of those are emerging market countries, tend to do well when commodities do well. So maybe thinking about increasing your emerging market exposure can also help offset some of that inflationary.
I mentioned earlier that money printing to finance government spending has gone seemingly well, amazingly, as we're up to $24 trillion in debt. The concern is if the demand for the US dollar declines, it's currently the global reserve currency, and during a recession, there's a significant demand for dollars. People need dollars to pay their rent, to pay their taxes. The demand maybe has never been higher than it was for the last few months. But what if the demand for the dollar for some reason declines? I realize the US is in a very good competitive situation globally, our economy, for a number of reasons. Some of them are as simple as we have navigable rivers that extend from the north part of the country to the south part of the country. We're just lucky in a lot of ways. And that's helped and will probably continue to help. But I imagine there is some situation in which the dollar is in less demand because of the fragility of the dollar, the inflation, the decline in the purchasing power of the dollar. If that were to happen, what is your guess? So I know we're in the land of speculation, but what becomes the next most compelling form of way to store value, to have some sort of a cash value? What is your take on that?
Yeah, that's the $1 million question, and I think, you know, when you're talking about the U.S. dollar being the reserve currency, you know, that is key right now. That has been the reason why we've been able to print so much money. If you think about other countries that do not have that luxury, they can't print money at will or as easily as what the United States is. So because we're the reserve currency, people need dollars. And I believe the figure that I saw was about 2/3 of all dollars are overseas. And so in order to transact in dollars, companies, or countries, I should say, need to keep dollars in reserves. And so the risk is if they no longer need those dollars, then those dollars will repatriate back to the United States, which could cause inflation. So that's one of the big risks. And if that were to happen, you know, in terms of other asset classes or you know, places to hold your money as a store of value, you know, you have to look back historically at what's worked. And one of those would be gold. Gold has not necessarily been a perfect hedge against inflation in the short term, but long term has definitely been a store of value that's been trusted. And so that is a possibility. But also I think we need to look ahead in terms of where things are going. And I don't think that you can exclude the possibility of things moving more in the digital space. And, you know, obviously people are probably most familiar with, you know, in the digital space of cryptocurrencies, similar like, you know, Bitcoin. And I'm not saying that the world's going to move on to Bitcoin. But I think Bitcoin has kind of helped to lead the way and to make it more acceptable. And as countries are now looking to maybe move their own currencies into a digital format, I know China has looked at like a digital yuan that I believe is close to being rolled out. I think we have to explore that and just stay on top of that space. Maybe there's some, you know, allocation towards some digital currency, but again, that's very speculative still, and it's not for everybody.
Yeah, I can't imagine which country or group of countries could represent the next most attractive reserve currency. I don't see it being the European Union. I don't think it's not going to be China. I cannot imagine it being another country. And I also cannot imagine the dollar going back to the gold standard. I would be totally shocked if that was ever something that we seriously discussed. So to your point, maybe gold is interesting, but if it's not a dollar backed by gold and it's actually gold, we haven't found a way yet to make gold something that could be used easily in transactions, although maybe a cryptocurrency model backed by gold is an interesting solution there that I've heard about. And I'm with you that I've never been more interested in the possibility of a digital currency, although I think what is Bitcoin, it's a few $100 billion in total assets.
Right. Market capitalization wise, yeah, I
Something
think
like
you're
that.
right.
And that it's certainly grown a tremendous amount in the last 10 years, but that is a vanishingly small portion of the total currency. So in order for it to make some sort of a serious impact, the demand for Bitcoin, I think, needs to grow. I think we need to be in the trillion plus neighborhood before it's seriously competitive and making an impact on the demand for dollars.
You know, you brought up a good point, and you know, historically, it has tended to be a country that is really kind of the primary reserve currency, of which we have that, you know, that position right now in the United States. And maybe that changes to be more like a special drawing, right, where it's a basket of countries, right, and how they determine the value of that, or how the representation of that. You know, I don't have all the answers there. Maybe it's somewhat commodity backed based on the assets of the country, but that might be something of that format in a digital currency could be a possibility. So we're talking about things that really don't even exist today, which makes it very speculative. But I think that's, you know, as we evolve more towards that digital currency, it's probably not going to look exactly like it does today, you know, with just one country in that dominant position.
I'll beat the drum of diversification one more time. And I think from a currency perspective, I think there's a valid case for beginning to consider diversification against currency risk more seriously. And some of that is in the form of more traditional assets, like diversifying your bonds, diversifying your stocks, having exposure to stocks where the currency may be affected differently from the dollar, like you said, emerging markets, incorporating non-traditional assets like commodities. And when it comes to currencies, I think there's a valid argument for introducing some exposure to stores of value that have historically had a low correlation to the dollar. But the question is always how much, because if that doesn't go well, what is the cost of that attempt at diversification? If the gold bet doesn't go well, or the Bitcoin bet doesn't go well, what cost are you willing to pay compared to the baseline scenario, which is just hold cash? That's always the hardest part to me.
Yeah, it is, and it's not. You know, you have to be careful. You don't want to unintentionally be making bets to where if they don't work out, then you know you're in a you have the unintended consequences of that, right? So the opportunity cost of if things don't go that negative, then you know you're basically shooting yourself in the foot there. So you know that's the question. It's a tough question. Maybe it's a 5 to 10% exposure, because if we have a black swan type event and that were to happen, and that small piece of the portfolio is up 1,000%, then you know it's going to, you know, it's still going to provide that stability to the portfolio. But if you make a big bet and you're wrong, to your point, you've got that opportunity cost on the other side. So that's the blend of art and science there in terms of how much. But probably from a planning perspective, the right call would be a smaller percentage of the portfolio, you know, and that's where my mind goes to 5 to 10%, somewhere in that range, to where you're not making huge bets, but you have exposure for that type of tail risk.
In one sense, holding non-traditional currency is like making insurance premium payments. You may never see those dollars again, but if something goes wrong, then it could pay off handsomely. So the question is, how much premium do you want to pay? You know, to use an insurance analogy.
Sure. Yeah, it's a good one.
Rip, thanks again for spending some time with me on a Friday, talking about a pretty heavy topic. Hope you enjoy your weekend. Have some fun. Lighten up.
Always a pleasure.
All right.
Take care.
Take care.